Hello friends, now in this video I will be taking three techniques of decision making: NPV, net present value method; IRR, internal rate of return method; and ROIC, return on invested capital method. These are part of capital investment and capital allocation learning module from corporate issuer. I'm targeting here LOS2, which says that number 1, describe the capital allocation process. So first of all, we have to describe what is this process, what are the steps of this process. Number 2, calculate, means numerical calculation will be there, NPV, IRR and ROIC. And the last part is contrast their use in capital allocation process. So we have to compare these three methods. So first of all, what is this capital allocation process? What do we mean by this process? What are the steps for this process, and what type of question we may get in the exam? So let's start. For NPV and IRR, both NPV and IRR are based on TVM, time value of money. So before going ahead for these two methods, it is expected that time value of money is already done by the student, and student is very much aware about using this calculator, CF, NPV and IRR keys. So let's start with the work, today's work. So first of all, what is capital allocation process? It is the process to make what? Capital investments and return decisions. So here what we are doing is we are going to do the decision making related to capital investment and returns. Basically, what return we should be getting from these investments. What do we mean by capital investment? So if I see this balance sheet of an organization, in case of liability side, there are long-term sources, which include your equity, your retained earnings, your debt finance, and then short-term sources, your trade credit or short-term debt. In the asset side, we have two type of assets: long-term or non-current, or fixed assets, which are of two categories. One can be tangible, having physical substance, and second is intangible, tangibles. And then we have short-term assets, which include inventories, receivables, etc. So these are the different part of balance sheet where we have to make decision. The first part, which is related to short-term asset and short-term sources, this is already covered in which topic? Working capital and liquidity management. Next part, which is your long-term sources decision making. What should be the structuring? What are the objective of this structuring? This we are covering in capital structure. In this chapter of capital structure, we will be discussing various theorems: Modi-Gilani-Miller, static trade-off theory, packing order theory, and these theory will help us or guide us to find out the best or optimum capital structure to achieve the objectives of business. What are the objectives of business? Of course, to maximize the value of the firm and value for the investors. So that will be covered under capital structure learning module. And now we are covering this module, that is decisions related to non-current, long-term or fixed assets. And these investments are called as capital investments. So what decision we have to make related to these long-term sources, long-term assets? So these are projects. These can be particular asset, plant, machinery, where businessman needs to make decision whether to invest or not, or if there are multiple projects, which projects should be given priority to maximize the value for the investors and value for the company as a whole. So these are the decisions which we are going to take in this particular module. So let's start. What is capital allocation process? So this is a process to take these decisions related to capital investment, that is decision related to long-term projects or long-term assets. What is the objective which we want to achieve? The objective is very clear. Objective for all decisions of business are same, that is to create value for investor and for the organization as a whole. Maximize the value for the investor and organization as a whole. So objective is to generate what? Objective is to generate risk adjusted returns. Now it's not only maximizing return, it is risk adjusted return. It means while taking these decisions, we should be considering giving adequate importance to risk factors also. So if risk is increasing, the expectation of investors will also increase, and if risk is going down, then the expectation will go down. So risk adjusted return we want to maximize, that is after considering the risk, the overall return should increase. Increase over what? Should be greater than what? Should be greater than the investor's opportunity cost of capital. Now question comes is, what is this opportunity cost of capital? Opportunity cost of capital is the return we can generate from the best next alternate opportunity. So if I am thinking to invest or start a factory having some X level of risk, and with the same level of risk I have another opportunity where I can generate 14% return. So from this new factory, new investment, new project, I should be getting minimum 14% or more than 14%, and that more than 14% is the objective of this particular decision. So here we are going to analyze various long-term projects. So it will be covering tenure more than 1 year. That's why discounting will be required. So here finally I can say that the objective of this particular decision is to maximize the value. And how value will be maximized? By generating return what is required by investor, to generate return more than what is required by the investor. And why investors are asking return? Because they are going to generate return from another opportunity, so they are asking return from your project also or your company also. So objective is to generate more than what they are asking. So next, now next is how to calculate this opportunity cost of capital for debt investor, for equity investor, and for the company as a whole, is already covered under capital structure module. And cost of equity will be calculated, we will be doing in the equity investment topic, and then the cost of debt we will be calculating in the fixed income topic. So at various point we are covering various these calculation of cost of capital. So for this particular topic, we are assuming that for NPV and IRR calculation, we will be given the required rate of return from both debt and equity holders point of view. Combined cost will be available in the question. So now what are the steps, and is it a very simple study? No, of course, since it is stretching more than for a longer period. So here time value of money will be involved, discounting will be done. So forecasting of various cash flows will be done, and the volatility, different aspects we have to cover. So it is a detailed study about investment in a project, and it utilizes significant proprietary and non-public information which is only available with the management for their analysis. So generally these information related to a particular project, management is not going to share it in the public domain or to the investors. So this is a detailed study which is done by management to decide whether to invest in a particular project or not. So what are the steps? Number one, the first step is idea generation. So any project will start with a new idea. First, management has to come up with a new idea, and from where this idea they can get, either from the existing management team, executives which are working with their in the current business, or sometimes they may also employ experts, external consultant they can be engaged for the idea generation. But when you are doing this idea generation, you should be considering the SWOT analysis also. SWOT analysis, SWOT. What are the strengths company is having? Where company is having competitive advantage? And what are the weaknesses also? What are the opportunities available against, and what are the threats available in the external environment? After considering all this, we should be going ahead to the next step of analysis. So idea generation is the first step, where the idea may originate from anywhere, often from managers engaged in the business or from the external consultants also. So this is the first step, where you will be analyzing your strengths as well as the opportunities available in the market, and they will be evaluated against your weaknesses, internal weaknesses, and the threats which are coming from the external market. Next, after this, once it is done, then we will go for the investment analysis. Investment analysis means we are going to do some numerical calculation, whether this is generating risk adjusted return for the investors or not, require more than what is required by them. So it involves forecasting. What forecasting? Amounts, timings. Timing is very important, but because this is a long-term decision, it is going to involve more than one period. So discounting will affect as per the timing, duration, and the volatility also. If there is any uncertainty, then we have to attach probability against the numbers what we are forecasting, and that probability will be also used for decision making of expected cash flows. Decision making techniques are used to estimate whether investment is value add or not. So here techniques are NPV, IRR, and ROIC. So these are the three techniques which we are going to do now. Next, third step is, so first of all, what are the type of question we may get from this particular first part of LOS that describe the capital allocation process? So I think there are two type of questions which we may get. Number one, the sequencing, to find out the correct sequencing of the capital allocation process, and number two, they may give you an activity and ask you to identify this activity belongs to which particular step of the capital allocation process. So if they ask you, okay, in which step we will be doing NPV calculation, of course it is part of investment analysis. Number two, if they ask you that the evaluation of strength and opportunities against the weakness and threat of the threat, then we will be saying it is part of the first top step, that is idea generation. Next, once the NPV and IRR gives a go ahead for the particular project, now we have to plan and prioritize, because there may be more than one opportunity which is available, and we may have constraint related to finance or other constraints also, other legal, regulatory, or ESG constraints also. So that there we have to prioritize that we have, even though the two projects are independently when we have evaluated, they are good for the company, they are adding value, but if they are mutually exclusive, accepting one is rejection of second, we have to prioritize which project we will be taking for the business. So it includes selection and ranking, especially in case of mutually exclusive. Though projects are 3 projects, 4 projects are profitable, you can go for only one project. There you have to do ranking, you have to select only one, because selection of one is rejection of others, even though they are profitable. So you have to rank profitable project based on risk adjusted return. The project which is going to maximize the risk adjusted return, of course that will be selected and that will be ranked number 1. Some projects are attractive in isolation, that's what I was saying. Some projects are good in on an isolation basis, but when they are compared with other profitable projects, basis may be less profitable. They are not, I'm not saying loss making, they are less profitable when considered along with existing operation or other proposed projects. So here you have to do the prioritizing, sequencing, you have to plan which project to take and which you should not be taking, even though it is profitable. Last part, once the project is already executed, you have already invested, now it's time to control, monitor. So it's monitoring and post investment review, because this is a very important step. This helps us to find out new ideas for the next projects. And this also helps us to improvise our forecasting also. Maybe we have done some error in existing project forecasting. To monitor the performance of the investment project, investment against projection, to make adjustments if there is any requirement that project is not going as per the plan, so you have to make the adjustment as whatever is required. If any, help validate assumption, reveal systematic error if we have done any error in the forecasting or analysis. Enforce discipline if the project is moving away from the defined limits or the defined parameters, then we have to discipline we have to bring things in order and produce new idea for the future investment. So in all, we are having 4 steps. Number 1, the first is idea generation, may come from any source, but you have to do the strength and opportunity evaluation against the threat and weaknesses. Number 2, you have to analyze investment analysis using the numerical techniques. Number 3, planning and prioritizing, and last one is monitoring and post investment reviews. So let's start with the techniques. Now, how to evaluate a particular project. So for internal management of the organization, of course, they have access to data of individual projects, so they will be doing more detailed analysis. But when it comes to the independent analyst who is external for the company, of course, company is not going to share internal project data with the external analyst. So external analyst will be having what type of data with him? He will be having the consolidated aggregate annual statement, annual financial statement, which are available in the public domain for his calculation. So for management, they have access to the project related, project by project information, detailed information, whereas investment analysts are generally having aggregate information in the form of consolidated financial statement, where the impact of all projects, if company is taking 10 projects, the financial statement give revenue from all those 10 projects. Revenue from independent individual project may not be available in the consolidated. That detail may not be available in the consolidated financial statement. We generally say CFS, consolidated financial statement. So let's come to the management part. So when management will be doing analysis, they will be either using NPV technique or IRR techniques. So what are these two techniques? NPV and internal rate of return technique are calculated for individual project, where ROIC is calculated for aggregate basis. Maybe an MCQ difference which they may ask. Next, first let's start the NPV technique. Now what is NPV technique? NPV, as the name says, net present value. Net means something got deducted from second thing. So net present value for me is what I am receiving minus what I have to pay. And since it's a long-term project, you cannot compare money which you have invested at T0 with the money which you are receiving after 2, 3, 4, 5 years down the line. So to make them comparable, you have to bring all numbers at a single place, and this place should be T0, that is today, because you have to take decision today. So we have to bring all future forecasted number to T0. For that, we will be doing discounting. And then what we will be doing? We will compare the inflows in present value term, which are now relatively equal to the outflow, which is also in terms of present value. So this present value of cash inflow will be compared with present value of cash outflow. And if there is any difference, excess is getting generated, that excess is called as NPV, net present value. So what is NPV? NPV is equals to PVCI, I used to say, present value of cash inflows minus present value of cash outflows. So it is the present value in currency terms. Of course, it's in absolute value, rupees terms or dollar terms, of expected future cash flows. It's the present value. We have to bring them back to T0, because a project is running for 4 years, T1, T2, T3 and T4. So I am using now time value of money symbols, because for this technique we need time value of money. So you will be incurring CF0 here, which is an outflow. And then you will be getting CF1, cash flow first, cash flow 2, cash flow 3 and cash flow 4. these CF1 to 4 are not directly comparable with CF0 because they are indexed at different point of time. What you have to do, you have to bring all these 4 cash flows back to your T0. So this value, this question mark is called as PVCI. Now this PVCI is comparable with your CF0, which you may say as PVCO, present value of cash outflow. Now they are comparable, and if your PVCI is greater than PVCO, so it is generating additional excess return over what is required, because when you are discounting, the discounting rate will be the return what you are requiring, or your investors risk adjusted rate of return what investors are asking for, or organization is asking for investing in this project. So once you are discounting it with your expected rate of return, your returns are already extracted. So now this PVCI is the return in the form of principal what you are investing. So if it is more than the principal what you are investing, or PVCO what you are investing, so it means you are generating excess over the PVCO. So it represents the amount by which investor wealth is increasing. I generally used to take example of a ice cream. This empty cone is your present value of cash outflow. And now investor is asking us COC to fill it with ice cream. And this ice cream is the return what they are asking, that is your cost of capital. So what is this NPV? So when you have discounted the CF1, CF2, CF3, CF4 with your required rate of return, this ice cream is already given back to the investors. Now what is left is PVCI, and if the value of this PVCI is more than your PVCO, so it means you are generating excess over what is required, and this excess is called as NPV. This excess is called as NPV. What is NPV? NPV is the present value in currency terms, absolute terms, of expected future cash flow less the investment cost. It represents the amount by which, because this cherry, this blue color cherry represent the extra return what investor is going to get over and above what he was asking for his investment. So it is going to increase the wealth of the investor more than what he was expecting from an investment. What is the formula for NPV? Formula of NPV is, of course, what you have to do, since CF0 is already negative number, it's an outflow. So what you have to do, you have to add up PVCI with your CF0, which is a negative number. So you may say you are subtracting actually PVCI minus PVCO. This is already a negative number. This is a negative number, and this is representing your PVCO itself. And these are your PVCI. These are your PVCI. So PVCI got adjusted with PVCO, and you are getting the NPV. What is the decision rule? If you are getting this cherry, you should be accepting the project, because investor is getting his PVCO back, he is getting his required rate of return, and he is getting more than what he is expecting. Even though the cherry is 0, that is NPV is 0, still whether you should be investing in the project, yes, because at least what investor is expecting, you are generating from the project. So that also is acceptable. Third, if NPV is negative, then in that case you should not be investing. Why you should not be investing? It means you are not generating sufficient profit what investor is asking. We will take numerical example. Now, decision rule we are already done. Invest if NPV is greater than equals to 0. There is a cherry, or even if it is not there but ice cream is there, that means cost of capital you are able to generate, then also you should be working. And if NPV is negative, you should not be investing. There are two terms which are used generally. One is called as conventional cash flow, and second is called as unconventional cash flow. It's simple terms, not very relevant from numerical part point of view. Conventional cash flow. Conventional project is that project, or conventional cash flows are those cash flows where you are investing once in a project, only one time, and then throughout the life of the project, you will be getting the positive inflows. That type of cash flow stream is called as conventional cash flow stream. or conventional project cash flow from the project. Unconventional, where there are when the project cash flows are changing sign multiple times. What do we mean by this? This means that there are multiple outflows at different point of time, T0 and T2, and there are multiple inflows, T1, T3 and T4. In case multiple inflows and outflows are there, then that type of cash flow stream is called as unconventional cash flow stream. That's it. So let's start with the calculation part of NPV first. So we are trying to analyze a project where the value of capital investment required today is equals to $100 million. $100 million are required to be invested in the project, and this project is going to be for 5 years. Okay. The required rate of return by both investor debt and equity put together is 10%. We generally used to say adjusted risk adjusted WACC. It's not direct WACC, it's risk adjusted WACC, which we will be discussing in the capital structure. So here it is already given. So investor want 10% and their return, their 100 million also back. There are two projects, project 1 and project 2, and you can select only one. The best part is if both projects are independent, then you can select both the project if they are positive NPV generating projects. But if it is a mutually exclusive situation, that means you cannot select both projects together. You have to select only one, even though both are profitable. So let's go for first calculation of NPV. So now these two projects, let's first analyze project 1. Project 1, there are 5 cash flows which are coming at different point of time, T1, T2, T3, T4 and T5 respectively. And there is outflow of 100 million and the required rate. How to calculate? We will be using CF function. First, let's clear the cash flow. CF0 is now 0. Let's invest the 100 million, 100 negative. Negative, we will input in CF0, then down arrow key to move to next cash flow. 20 million, CF01, down, frequency one time only. Next 25. Use of this calculator key is already covered under time value of money, so I'm expecting everyone know how to use these keys. CF2 25, 30, 40 and 50. Next, your required rate of return I, that NPV key we are using. The first when you will press NPV, you will get I, that is required rate of return is 10%. Set, enter. Next, calculate NPV, compute NPV. So here you got NPV equals to, for project A is equals to 19.7490 direct. Next, let's go for calculation. What I have actually done, I have NPV of A is equals to minus 100 million plus 20 divided by 1.1 plus 25 divided by 1.10 square, 30 divided by 1.10 cube, and second last 40 divided by 1.10 power 4, and last 50 divided by 1.10 power 5. So this is your PVCI, CI, and this negative is this represent your PVCO. So this is already a negative number. So this PVCI adjusted for PVCO is giving you NPV for project A. And now both are, since you are already discounting it with 10%, you have already extracted 10% return. Both are now standing at T0, PVCI and PVCO. They are directly comparable. So it means your project is not only giving 10% return and 100 million back, but it is also giving over and above that 100 million, 19.7490 million extra to the company. Let's go for same way calculation of NPV for B. Again, second CF, second 0. You have to clear cash flow. 100 negative. CF1 is 30. So why I have taken these two cash flow? If you say this pattern is conventional and this pattern is non-conventional or unconventional. So CF C01 30, next, set, next. 10 negative. 40 positive. There is no difference in calculation of NPV, so nothing to worry for calculation part. 50 and 20. Again 10% NPV. So this is giving a negative NPV of 4.37%. Let's increase some numbers. Let's make this number as 50 or 40. 40, not 50. 50. Let's make it 50. So I am changing CF5 to 50. So how we are going to enter? 100 negative, C0, C1 30, C0 to taken 10 negative, 40 positive, 50, and 50 is coming 2 times. Both are positive. What you need not to put C05, just put frequency as 2 and then 10 as my rate and then my NPV. Now I have got the positive NPV of how much? 14.2576. Because negative NPV, there will be no prioritizing, because second project is already rejected because of negative NPV. Now, if these are mutually exclusive project, first, both are generating positive NPV. So in isolation, individually, they are profitable for from company's point of view. But if both projects are independent, means one selection of one is not rejection of another. So you can select multiple projects, invest in both projects, both the projects, as they are generating positive NPV. Now, second case, if projects are mutually exclusive, what do you mean by this? Means investing in one is rejection of other. Which project you are going to select? Though both are profitable, we will select the higher project generating higher profitability. Invest in project 1 or A or 1. This is A and this is B. Invest in project A with highest positive NPV. So I hope everyone understood the calculation of NPV. What NPV is doing? NPV is generating cherry on the ice cream. Ice cream means the empty cone is already returned in the form of PVCO. Required rate of return COC in the form of ice cream is also already returned by discounting. And this cherry represent the excess amount what is generated by the project for the company, and which is going to increase the overall value of the company and for the investors. So next technique, second technique is IRR, internal rate of return. Again, time value of money based technique, considering cash flows for discounting and considering the entire time life of the project. So it is the discounting rate. So it is not absolute term. NPV, we were calculating in currency terms, and this is we are going to calculate in terms of discounting rate. So here rate is missing. That makes the present value of an investment equals to 0. Now, what this rate means? This rate means when I say that I want to, let's take some example, illustration 1, I want to say that if I am investing at T0 1 CR and I am going to 1 million and I am going to generate 1.1 million at T1. What is the return I have got for on a per annum basis? Of course, 10% return. So 1 year, 1.1 minus 1 upon 1 into 100, you can say percentage change formula. But now let's go for another illustration. I'm investing for 2 years. 100 rupees and I'm getting 121 rupees at T2. What is the return I have generated in this second illustration? Is it 21%? I want return on a per annum basis. Is it 10.5%? 121 minus 100 upon 100, that is 21% divided by 2 years, or 10%. which is the correct way to present return. First 21, 10.5, second, or the third one 10%. Of course, it is 10%. How I got this 10%? I am using the same time value of money formula. 121 is equals to 100 got compounded for 2 years. So R is equals to 121 divided by 100 power 1 by 2 minus 1. I got a return of 10%. So this, what exactly I have done? What exactly I have done? I have used CAGR, CAGR, and the CAGR is generating me return of on a compounded basis, on a annualized basis, annualized compounded return, compounded annualized growth rate or growth returns for the from the project. So these are the two simple example of generating returns. In case of 1 year, there was no compounding, so it was very easy to calculate. But when there is when the period is more than 1 year, you should be using compounded returns. But how this IRR is going to be calculated? Now, this was a very simple example of only two cash flow, one at T0 and a second at the last of the project. Assuming now I am going to invest in a project of 2 years. 100 rupees I am going to generate, and first year I am getting 60 and second year I am getting 70 rupees as inflow. Now I want to find out on a compounded basis, what is my annualized return generated from this project. Can I say I have got 130 rupees, 60 plus 70, 130 rupees minus 100 over 100, that is 30% return? No. Because this 30% return is absolute percentage. Divided by 2 year, 15% return per annum. No, again compounding is not there. So how can we use CAGR formula as we have used in this illustration to CAGR formula? No, it is also not possible. Future value upon present value power 1 by T minus 1. No, it is also not possible. Because for CAGR formula, there should be no intermediate cash flows. There are intermediate cash flows. So I don't know what is the return included in this. I want to find out what is the return inbuilt, implicit, or internal rate of return of this project. Let IRR is equals to X. So I know that the 60 rupees is having 1 year return into it. And the 70 rupees is having X percentage for 2 years with a compounding effect. Let's extract the X percentage return as per the timing. So if I want to extract X percentage, I have to discount it by X percent. So if I discount it by X percent, my first part, that is 60 rupees, will become 60 upon 1 plus X to the power 1. And the 70 will be discounted by 1 plus X to the power 2. Now X percent is already extracted as per the respective timing of the cash flow. So what is left? This 60 rupees is including the CF1 is inclusive of some part of P1 principal, some part of principal is returning, and 1 year return is coming at the rate X percent. P1 1 plus X to the power 1. So if I want to find out P1, it is CF1 upon 1 plus X to the power 1, which I have already done. So this is representing my P1. Some part of principal, what I have already invested. 70 rupees is P2, some part of principal which is coming back, and 2 year returns at the rate X percent on that P2. So CF2 is equals to P2 1 plus X to the power 2. So I can say P2 is equals to CF2 1 plus X to the power 2. This I have already done. So I have got the P2. And what should be the sum of this P1 and P2? Of course, the P1 and P2 are representing the part of principal what you are getting back from the project. So sum of these part must be equals to whole. Sum of the part must be equals to whole, means P1 and P2 should be equals to your overall principal, that is equals to your 100 rupees. So ultimately what equation I am using, it is 100 is equals to 60 upon 1 plus X to the power 1 plus 70 upon X to the power 2. If I solve this equation for X, the value of X represents the inbuilt, implicit, or internal rate of return in this project. I can say at IRR, my PVCO should be equals to PVCI. Present, because this is discounted value. So discounted value is present value. My PVC or present value of cash outflow should be equals to present value of cash inflows. Now how to calculate it? Very simple. We have again CF functions, CF0, second CF, second 0. Let's clear it. Put 100 negative. Then CF1 60, CF2 70. That's it. Press IRR and compute. You got your IRR X% as my IRR as 18.8819% per annum. This 18.8819% represent my compounded annualized return generated from this particular project, illustration number 3. Same basis, same method we will be using for calculating the IRR for these two projects A and B also. But first let's find out what is this text is saying. So IRR is the discounting rate. It's the rate which we are calculating that makes present value of an investment equals to 0. Now why it is saying present value of investment equals to 0? Because here we have equated PVCI with PVCO. And what is NPV? NPV is equals to PVCI minus PVCO. So if these two are equal, automatically at IRR, if these two are equal, so NPV at IRR will be equals to 0. If you discount these cash flow 60 and 70 by 18.8819%, let's discount it. So this CF is already there, 60 and 70. Let's put the 18.8819% as my I, and let's calculate the NPV. It is coming almost 0. Because you have extracted the complete return, then the value is equals to the principal. So what is the excess you are getting? Nothing. Because the return is already extracted. The overall return is already extracted. In case of NPV calculation, we have extracted only 10%, the required return, not the overall return. Not the overall return. What is IRR? IRR is the discount rate that makes present value of investment equals to 0. So we may get what type of question we will be getting? We will be getting a simple question of where cash flows are given, conventional, unconventional, and required rate is given, and they ask you to calculate NPV. Or they will give a situation that these projects are independent or these projects are mutually exclusive. Find out which project will be selected, A, B, or both, or none of the two. Same basis, they will give same type of data, because finally the same data is used for IRR and NPV. And they will ask you to calculate IRR for the project. And on the basis of IRR, they will ask you to select the project if they are independent, if they are mutually exclusive. Second type of question is they can ask you to to find out the relationship between NPV and IRR. So that part we will cover after the numerical illustration. What will be the situation of NPV if IRR is at X level or IRR is at a Y level? Let's see. So IRR, we have got that this is the situation where there is a discounted rate where present value of investment will be equals to 0, including your CF0. What you have done, PVCI got adjusted for your PVCO. CF0 is already negative. So, and here you are discounting by IRR, not the COC as we have done the required rate as we have done in the NPV calculation. So both are different things. In NPV, you have extracted the required return. In IRR, you are finding out what is the return in it. So, till now, we have not used the required return. So where it will be used? So decision rule now we have calculated this IRR of 18% for this our illustration. Now whether to accept or not? This 18 will be compared with what? This project is generating 18.88%. Now we will find out what is required by the company or the investor for investing in this project. Required rate of return. And that required rate of return is treated as the hurdle rate, that this or benchmark rate or cutoff rate. This is the minimum level at which the project should generate. So if in this illustration 3, if the hurdle rate, cutoff rate, benchmark rate or required rate is 15%, whether you should be accepting the project, yes or no? Yes. Investor want 15%, we are generating 18.88%. Second case, If investors' required rate of return as per the risk of this project is 18.88%, 8819%, then whether should accept or not? Yes, still yes. Theoretically, yes. Investors are asking 18.88% and we are generating 18.88%. Why not to go ahead with the business? We should be doing business at break even also. At least return what is required is already generating. There is no loss. And if the investors are asking for 20% as per the risk profile of this project, whether we should be accepting this project? Of course, no. The project is going to decrease the value of overall company. So, decision rule, IRR should be compared with hurdle rate, and this hurdle rate or required rate or cutoff rate or benchmark rate is given by investor as per the risk profile of the project. So, IRR greater than, even including equals to R, you should be accepting. If it is less, you should be rejecting. Few small things we should be aware of while doing this cash flow analysis, because here I have already given you cash flow after taxes. So first of all, I am writing cash flow. What do you mean by cash flow? Cash flow means sales less your variable cost already paid, less your fixed cost already paid. Depreciation is already there, which you have subtracted, but this is a non-fixed cost. But let's subtract depreciation also. Then whatever is your profit, on that profit you have already paid taxes also. And then you have added back sales, less VC, less fixed cost, less taxes. And this is, if it is including depreciation, you have to add back depreciation. This is your cash flow from project after taxes. First of all, it is cash flow, not earnings, which we are using, because discounting is done on cash flows. Earning is based on accounting numbers, whereas cash flows are the actual cash which is coming or going out. So you should be discounting cash flows on time series. It's the point of time where cash is received is important for discounting, not the earning where it is accrued as per the accounts. Second, even though you had already paid some cash expenses on a project, that will not be considered for investment. Why? Because these are treated as sunk cost. Example is research cost. You have already incurred some XYZ amount, 60,000 rupees or 1 lakh rupees on research. And after research, you have generated an idea. And now this idea, you are going for commercial production, for which you are going to set up some factories, etc., facilities, etc. So that research cost, which is already incurred, cannot be recovered. It's already gone. It's sunk cost. Irrelevant for decision making, future decisions. Generally, historic costs are sunk cost, or already committed costs are sunk cost, which has nothing to do with the yes or no, accept or reject of the project. They should not be considered while doing the calculation. Only the incremental cash flows should be considered. The cash flows which you will be getting inflow or outflow because of the project. Second thing, if there is any opportunity lost by taking the project because of cannibalization, means you are launching one product which is going to decrease the sales or earnings of second product which is already there in your product profile. In that case, that loss in the existing business should also be considered while calculating the NPV and IRR of this new project. Opportunity loss due to new project is considered as incremental cash flow, of course outflow, in NPV and IRR analysis. And this can be a gain also, because of the new project you are getting additional advantage in your existing business. You are getting more sales because you have got a complementary product. That additional revenue in the existing business should also be considered in this project analysis. So theoretical part, of course it in numerics it is going to complex the situation. Let's calculate the IRR for both the projects. Simple IRR, same time value of money keys we are going to use. Let's clear the cash flow numbers. 100 negative. First project we have 20, CF1 25, 2, CF3 30, CF4 40, and 5 is 50. Let's check 100, 20, 25, 30, 40 and 50. Now press IRR key and compute. That's it. This is directly going to calculate IRR for project A. IRR for project A is 16.3428%, which is greater than 10% required rate of return. So in individually, this project is acceptable. Let's go for IRR of B. It is having unconventional cash flows. Again, second CF, second clear, 100 negative. Next, 30, 10 negative, 40, 50, 2 times, frequency is 2 now. Let's set IRR is equals to, so IRR of project B is also 14.4031%, which is also greater than 10%. So if these projects are independent situation, select both projects. If mutually exclusive, we should be selecting the project which is generating higher IRR, higher returns over the investment, which is invest or select project A with highest or higher IRR, and of course this is more than your required rate also. So hopefully with this everyone understood the calculation of NPV and IRR technique used by management, because they have data related to project on a very uh, non-public, and what it was written, non-public and something was written, non-public and proprietary information is available, which is not available to public. So this NPV and IRR calculation will be only done by management because they have project specific data of cash flows, etc. So now what if you are working as an investment analyst who is not having access to the individual project specific data, and we are only having access to aggregate CFS, consolidated financial statement, then how we are going to evaluate the performance of the company? In that case, we will be using ROIC method, return on invested capital method, and this is a calculation which is done on a aggregate basis. So let's start with the ROIC method, the last method. But before that, is there any out of these two methods, which method is more better, NPV and IRR? Which method is superior? Two reasons for which NPV is superior. Two reasons for which NPV is superior. Can NPV and IRR gives contradictory decisions? The question is, superiority will come when there is a contradiction. This is the third part of the LOS. Contrast these methods. IRR and NPV can give contradictory decision. IRR may say select project A, NPV may say to select project B. When I am saying like this, it means it's a situation of mutually exclusive, multiple projects. In case of single project, generally 99.99% there are no chances of deviation in the decision. NPV says accept, IRR will also say accept. If these are independent projects, still there will be no conflict. The conflict of decision will arise only in case of mutually exclusive in some situation, some specific situation. These situations can be not covered in our curriculum, can be mutually, in case of mutually exclusive situations where there is a huge difference of life of project. One is of 10 years, second is of 50 years. Sometimes this difference will come, conflict will come, otherwise generally both will give same decision selection. When there is a difference in pattern of cash flow, when I say pattern of cash flow, one is giving cash flows in ascending order, inflows, second is giving cash flows in descending order, then also there may be a difference in the decision selection. Third case, when there is a difference, huge difference in your PVCO, that is your initial investment. One is of 1 CR, 1 million, and second is of 20 million. And you have to select only one out of these projects. Then in these cases, there can be difference of selection because of these two methods, from these two methods. So NPV method, why the reason is NPV method assumes that what we have done this calculation, we have done the calculation by discounting these interim cash flows by your COC. Means we are bringing back to T0 by discounting, extracting the return of COC only. So here it is an inbuilt assumption that assuming that interim cash flows are reinvested at R, your hurdle rate, required rate, and which is economically realistic also. You are discounting 10% because you are assuming that in a different opportunity with the same risk class, we will get this return. So you should be expecting this return, and this is economically realistic assumption. Whereas in case of IRR, when I have done this discounting by X%, but I have assumed that the rate which should be used for compounding and discounting should be IRR. It means these interim cash flows will be reinvested if required to be invested for future. Then only this CAGR will come. It is as good as your CAGR. This CAGR will be generated only if you are investing this 60 rupees for additional 1 year at this rate. How come? 100 is equals to 60 divided by 1 plus x to the power 1 and 70 divided by 1 plus x to the power 2. It means 100, 1 plus x to the power square is equals to 60, 1 plus x compounding for 1 year from T1 to T2. This is compounding plus 70. So this becomes future value of cash flow, at T2 compounded at IRR rate. And this x is also representing IRR. So if I calculate x, it is equals to future value of cash flows, which is compounded at IRR. It means intermediate cash flows are reinvested at IRR rate upon your PVCO, your cash flow 0, T0 upon power 1 upon n minus 1. And this represent your CAGR formula. This CAGR will be only generated if your future cash flows, the intermediate cash flows are reinvested for the remaining balance period of tenure of the project at IRR rate, which you may get, may not get. It means this 18% you will be realizing, only if the 60 rupees get invested for additional 1 year at this rate. But at T1 you will get same return giving opportunity may not be there in the practically may not be there available. So real scenario, you will not be actually generating 18.89 by the end of second year. Today at T0 it is we can say we will be generating 18.89 subject to the condition that the 60 will be reinvested at this return for remaining tenure. No, may not hold true in real scenario. So this is the main reason for difference in the selection of a project, that here the assumption of NPV is more realistic to assume that intermediate cash flows will be reinvested at COC, whereas IRR assume that intermediate cash flows are reinvested at IRR rate. Here it is reinvested at a required rate. IRR may not be available in different other projects for reinvesting the intermediate cash flows. That is why NPV technique is generally treated superior than the IRR technique. Second reason, there are, in case of unconventional cash flows, when multiple change of sign is there, positive, negative, positive, negative, positive. Calculation with certain type of data, the project may, the calculation may generate two different numbers of IRR. If we calculate the present value of CF1 and CF2 at 100%, it is equal to 1000. And if we discount it by 200%, even still it is coming 1000. It means the project is generating NPV equals to 0. That was the definition of IRR. that present value of cash flow will be coming at 0. The discounting rate at which present value will come at 0. If you discount these three cash flows at 100% as well as at 200%, both are coming 0. Both will be treated as IRR. Whether you will select the project or reject the project. Let's say if unrealistic, very high number, let's say my hurdle rate is equals to 125%. Will you accept or will you reject? If I compare it with 100% IRR, I will say no, because my IRR is less than my hurdle rate. And if I compare it with 200%, I will say yes. Again, there is a no decision scenario. That is why it mutually exclusive situation, in mutually exclusive project, it is recommended to use NPV for decision. These are the two reasons which proves that NPV is superior than IRR. But still, IRR is also having its own importance. Let's go for the last part, return on invested capital. This will be used by analysts who are not having access to individual project specific data. So they will be working on the aggregate CFS, consolidated financial statement, that is working on the overall number of the company. Overall number of the company. What is ROIC? Very simple formula. It is net after tax operating profit, which is EBIT into 1 minus tax. For the year, the overall return what company generated after paying the tax from the business, including all the projects put together, divided by your average invested capital. Capital means long-term finance. Long-term finance, including your long-term debt, liabilities as well as equity. How to calculate it? Then we will go for advantage and limitation. Of course, limitation is there because this is calculated for 1 year. 1 year data is used, whereas project will be of 5 year, 10 year. Just by looking at 1 year ROIC, if you take a decision of a long-term investment of project, may not be correct way of deciding. But it's still a method where complete specific 100% data is not there, or to get an idea whether to go for a project or not. Required rate of return by investor is, let's say, 12%. They want 12% return from the overall business. Operating profit for year 2 is $10,000. Tax rate is 30%. We have share capital, it's a long-term source. We have reserve surplus, we have long-term source, long-term debt, long-term source, short-term, and accounts payable is also short-term. For year 1 and year 2, we have to calculate average capital employed. So capital employed for year 1 is how much? 10 plus 20, 30 plus 55,000. Capital employed in this case 10, 23, 33 and 63,000. Average capital employed 55,000 plus 63,000 divided by 2. 55 plus 63 over 2 is equals to 59,000 is my average capital employed. What is my ROIC? Return on invested capital is net operating profit, EBIT, 1 minus tax, net after tax net operating profit upon average capital employed. This equals to 10,000 multiplied by 100. So 10,000, tax rate is 30% on 59,000 into 100. This is going to give us 10 into 0.77 divided by 59% is equals to 11.8644% per annum. So this company overall company is generating 11.866%, whereas the required rate of return by investor is 12%. You should not be investing. Do not invest. Simple calculation of ROC, it's a ratio which is using accounting data for a year. May not be very good method of investment analysis for a long-term project, but one of the method where the individual project level data is not available. What it is saying, advantages calculated based on data available, whatever is available we are using it. Number 2, it is based on amount invested to generate return rather than the sales. This is based on the amount invested. This is basically a profitability ratio based on investment rather than sales. Gross profit ratio, gross margin or net margin or operating margin is a return based on the amount invested. It's okay, but it is still not a very good advantage. ROC can be increased. Okay, this is important from your point of view. If I see, if I split ROIC formula is your average after tax operating profit upon capital employed, average capital employed. If I divide it by sales and multiply it by sales, so this first formula becomes my operating margin, that is profitability ratio based on sales, and second become my capital turnover ratio, that is my activity ratio. So if I want to increase my ROIC, business can increase its ROIC by increasing either of the two. Either increase your operating margin by reducing the expenses, automatic your sales, less expenses your operating profit. So if your expenses are reducing or taxes are reducing, your operating margin will, after tax operating margin will. Or increase the capital turnover, for the same capital employed, increase the turnover of the company. So by increasing these two ratios, either of the two ratio, you can increase ROIC also. ROIC can be compared with investor required rate, which we have already done, and we have taken a decision that required rate is more than the ROIC, you should not be invested. Limitation. Okay, one more thing, it will be compared with the WACC, not the cost of equity or cost of debt, because we are using operating profits, not the equity returns, earning available for equity returns. Since this profit is available for both debt and equity investors, it should be compared with the required rate of return of both the investors, which is represented by WACC. Limitation, it's accounting measure which can be manipulated by manipulating the accounts. Use different depreciation rate, use different useful life, automatically accrual system will impact your ROIC. It's a backward looking, calculated for the past using the past data. It's not related to future. And profitable investment can sometimes take longer time to generate competitive return. This is not very efficient method because this is using a 1 year data. And 10-year project may not generate initially profit. It will maybe generating profit in the later part of its life. Or some projects which are overall having a negative effect on the company, but since they are generating higher return in the initial year, they will be accepted. This is a limitation. It's an aggregate measure. It means it's going to average out to the effect of good performing and bad performing projects. This is again a limitation, because you will not be able to identify the specific project which is negative for the company's value creation. These are and further last disadvantage or limitation, this denominator, average long term liabilities. Few people say you should exclude cash, intangibles, goodwill, etc., or your I think provisions, what it is saying, or some certain liabilities related to your pension, etc., because they are not actually investment in the business. So with these limitations, we know that ROIC is not a very efficient way of decision making for a project, but if you are having aggregate data, accounting data only, then this is the best method. With this, we are done with all the three methods along with their numerical calculation. Hopefully everyone understood it. Thank you so much. Thank you everyone.